This is King World News. I'm Eric King, and you are about to hear the interview with Michael OHiggins, so well known for his Dogs of the Dow theory. For more interviews, remember to go to our homepage at www.kingworldnews.com, where this week we have a terrific interview with Congressman Stearns discussing his exchange with former Treasury Secretary Henry Paulson. We also have John Malden, who authors the weekly Thoughts from the Frontline and Outside the Box. Joining us now is Michael OHiggins of OHiggins Asset Management, considered one of the top money managers in the United States. Mr. OHiggins is also the author of the best-selling investment classic Beating the Dow, which popularized the very successful Dogs of the Dow strategy. This was from your piece, which was published in April of this year in Dr. Mark Faber's newsletter, The Gloom, Boom, and Doom Report. 5 times since early 1999, I have written short articles for this newsletter giving my views on the investment outlook and the vehicles that I recommended using to capitalize on the developments which I foresaw. Investors who followed the recommendations made in the first 3 articles and invested equal amounts each time would have done very well through the end of February of this year, with average cumulative returns of 146.9%. versus negative 22% in the S&P 500. Those who followed the investment recommendations in all 5 would have done relatively well, with average cumulative returns of 64.3% versus losses of 29.7% in the S&P 500. End quote. What do you credit for your success? Was there individual early on in your career, or was it that you entered the investment world in 1972 right before the big bear market of 73.4 that sharpened you, or a combination of all that? What has made you so successful, would you say, Michael?
To the degree that I've had any success at all, I think I've paid a great deal of attention. I've studied the past. I've paid attention over the past 38 years that I've been in the business, and I study the present. So I generally have a fairly good idea of where a lot of things have traded and are trading right now relative to one another and relative to themselves, their own history. So I think, unlike some people in our business, and I'm not saying that there aren't, because there are literally thousands, probably tens of thousands of ways to skin the cat in this business to outperform. It's just a question of paying attention and having a sense of when things are expensive and when they're cheap, when risk is high and when risk is low, which are kind of related to one another.
What was the bear market of 73.4 like? Because you wrote about that at one point, and I've heard some in the business describe it as grinding, that you would get up, go to work, the market would go down 1%, and then you would go home. What was that experience like for you?
Well, I was very fortunate to have started then, because I never had a bull market to get spoiled with. And also, too, those were really the 2 final years of a decline that had really started probably in late 65, early 66, when the Dow first hit 1,000. And so it went from there down to 7-something, then back to 1,000, then down to 620, then back to 1,000, then down to 566 or so, which was the December bottom in 1974. So from that point on, really stocks never got that cheap again. They went from there back to 1,000. Then it largely traded between 770 and 1,000 for a couple of years. And then in 82, they broke through 1,000 for the last time and went to 12,000, basically, never looked back. But we had a 20-year period from 62 to 82 where the Dow traded between 750 and 1,000. But other than that, you were pretty much range bound between 750 and 1,000. And the whole time, of course, finally in 82, when interest rates started coming down again, stocks were selling at 7 times earnings, yielding 7.5%. And we got into the disinflation of the 80s and 90s, and that was so interest rates pretty much went down. Long-term rates went down from 15% to below 5 over a period. So, you have these long periods in the past. If you bought stocks in 29, it was 1954 before the Dow made a new high.
Right.
And in between that, from 1932 to 1952, the Dow traded, for the most part, between 100 and 200 for 20 years. And then in 52, it broke out above the 200. And people, they developed, basically they became conditioned to buy at 100 and sell at 200. Then, of course, it broke through 200 and went to 1,000. There's an interesting chart that showed how big market moves follow periods of big inflation. And it's remarkable how, once the inflation stops, then the market catches up. During that period of time, the market has trouble going anywhere. And my guess is we're in an inflationary period. If you look back, this is really a movie of the 80s and 90s running backwards. You had taxes going down, interest rates going down, government spending as a percentage of GDP going down, unions losing power, government losing power. I mean, on and on and on, everywhere you look. Now, what do you have? You have the unions are in control. You have the government growing again as a percentage of GDP. You have inflation about to explode. The business conditions are, the government is definitely anti-business. All kinds of new government spending proposals in the works. It's Carter on steroids.
You occasionally write for Dr. Faber's newsletter, and this was from the one from April, I believe. While many of the developments that we have witnessed in the global financial markets and world economy over the past year and a quarter are reminiscent of those that occurred during the Great Crash of 1929 to 32 and the ensuing Great Depression, leading many market analysts and economists to assume that we are headed for a similarly deflationary environment. My guess is that our future will be very different than that, end quote. You went on to talk about Fed Chairman Ben Bernanke and quote his famous speech where he talked about dropping money from helicopters. We conclude that under a paper money system, a determined government can always generate higher spending and hence positive inflation. My question for you here, Michael, is because you obviously are looking for inflation, but when, in your opinion, will the serious inflation start in the United States?
Well, I think when all of the money and credit that's being put out starts to stick. Right now, a lot of it is basically into reserves and is not being spent. And as I used to say years ago, people say, well, how is this going to happen? How are you going to have this major economic contraction? I said, it's very simple. People that they want to lend to aren't going to want to borrow. And the people that want to borrow, they're not going to want to lend to. And that's where we are right now.
Right.
Sure, they'd love to lend to me. I don't have a penny of debt, and I have assets and income and all free and clear. But I don't want to borrow for what? But on the other hand, Joe Sixpack is up to his eyeballs in credit card debt and upside down in his house and car and everything else, and you're not going to lend to him. So you need to get that multiplier effect, and that still hasn't kicked in really. But when, what they have to do, they have two choices. Anybody does if he has, especially with the government since they have the printing press. And when you owe a lot of money, you have 3 or 4 choices, all right? Let's say 4. You can pay it back. You can go bankrupt and default. They don't want to do that. You can try to grow your way out of it. But the policies that they're putting in place aren't going to accomplish that. You're not going to grow your way out of it by growing the government. You're going to grow your way out of it. As Mark Faber says, the solution is cut spending, cut taxes, and put money back into the private sector, where you could get some real productivity growth. Or you can inflate it away. That's the most attractive choice.
When I interviewed Dr. Mark Faber, he described Bernanke as a madman and a destroyer of wealth and an economic criminal, and talked about the fact that Hitler wrote Mein Kampf, and in that he outlined his plans for Germany. And Dr. Faber was saying Bernanke has outlined his plans for the United States and that he is insane like Hitler, and we will certainly have hyperinflation. And some would say those are pretty strong words, but is Dr. Mark Faber right, Michael? And how dangerous is Bernanke?
Well, it depends on what side of the coin you're on. Look, prior to Herbert Hoover, we had